There was no high-yield debt issuance in the month of December, and it's the first time that's happened in a decade.
Yeah,
is that an ominous sign? I remember during the financial crisis, which you lived through and you led with such great leadership, it was the debt markets that got us into trouble.
Yeah, but it was the deleveraging, the liquidation of debt markets, not the lack of issuance. So my view is that in December things slowed down, people got scared, issuers didn't want to issue, spreads gapped out. That'll probably change.
How long can the credit market stay this tight before you actually do see it as a worry sign?
For a while. I'm really not worried about it. I think you're just having. If you look at the other way around, credit spreads were abnormally low for a long time. This is more maybe a little bit of a normalization. And you know, you and I both know that the tip of the iceberg, the tip of the spear, is IPOs and high yield. So when sentiment changes dramatically, those are usually the first two areas where people cut back. And then they kind of open up over time.
The fundamentals seem to be okay, putting the market volatility aside. But you've got a great vantage point in seeing how consumers are doing from your credit card business. Yeah. What are you seeing?
So credit card, I mean, it's very good. I mean, again, if you look at actual data, people getting jobs, more people working, wages going up, wages are going up. Household balance sheet in very good shape, credit card credit, extraordinarily good. I think it's better than we deserve at this point in the cycle. And if you look at actual spend, you know, if you look at retail spend, home improvement spend, a whole bunch of it's pretty good. And so, you know, my view is that the consumer's in good shape and is continuing to grow, and they have backwind with jobs and wages going up.
Speaking of normalized, the Federal Reserve is trying to normalize interest rates now, raising rates from these rock bottom levels that we were at. Is the Fed doing the right thing in your view? How many Fed hikes do you think we should see in the year ahead, and how many might we see?
Yeah, I remind people years ago, you know, the Fed didn't forecast and all that type of thing. Paul Volcker raised rates effectively 200 basis points on a Sunday night. No one completely knows the future, so the Fed obviously has to be data dependent. And I think that data dependency is both interest rates and maybe how they manage the balance sheet a little bit. They are very bright people. I have enormous respect for Chairman Powell. And they'll look at the situation and adjust it accordingly. But my own view is if we had good growth, raising rates, normalizing, so normalize would be kind of 3% the short end and maybe 4% the 10-year, is a good thing.
So you don't think markets, though, are indicating a recession is on the horizon over the near term, then?
No. I think markets are overreacting to short-term sentiment around a whole bunch of complex issues.
What about the shrinkage in money supply?
But actually, I should have said some of it is a rational response. So, you know, stock prices are at 18 PE, and now they're at 16 because you think there's going to be slower growth, higher chance of recession, higher chance of a trade war. That is a rational adjustment. You shouldn't say that that's irrational. You and I would say that's probably pretty rational. You pay less under that environment because you think the future is going to be very different than you thought it was before.
Actually, you know better than I do, but when I think about things, the Federal Reserve makes a pivot. They say they're in no rush. Earnings have been pretty strong. We just had great jobs numbers on Friday, 312,000 jobs created. Valuations are better after the last 3 months. Yeah. Seems like we could be poised for a rip-roaring rally.
Yeah, that's why I think people react. I don't know about rip-roaring rally, but I think you're going to have decent growth in 2019 in America. And therefore, Senate may reverse course a little bit down the road. I hate guessing about the future. I mean, I run my business like serving you as a client. Right. And then we navigate the ups and downs of markets.
But just to be clear, when you look at what happened in the inversion, or when you look at the no high-yield debt issuance, that's real time, and that's telling us something right now. It's not speculating.
Yeah. I think that's true. But again, I look at the inversion a little bit. Because of QE, I wouldn't give it as quite high importance as I would have before. We don't know the exact effect of QE, and I still suspect that somehow that 10-year bond today should be at 4%. Now, I've been wrong about that, but you know, when you've had 2% inflation, a normal 10-year bond rate is 4%. And we don't have that, and that may be because of not just U.S. QE, by the way. So if you're the Federal Reserve, you've had QE around the world. You know, for a long time, the ECB was buying 100% of sovereign debt issuance in Europe. And for a couple of years, that was true here. We've never seen something like that before. Maybe during World War II we had some of that, but you know, so we don't know exactly what the reverse will be. But I have a little faith in that our folks will navigate it.